Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Tuesday, February 17th, 2026, and the indexes finished just barely green, but it did not trade like a celebration. Every push higher met with quiet selling. Breakout attempts? They didn't stick. It felt like positioning trying to hold together, not a market buying with conviction. Big theme of the day: narrow leadership, broad hesitation. Parts of mega-cap growth stayed heavy, and participation just didn't really expand. Now, look at the S&P 500 heatmap. On the surface, it's modestly green. But the internals are argumentative. You've got clear leadership concentration, Apple, and a couple of key semis lighting up, while a lot of other high-visibility tiles lean red or just flat gray. And the eye-catcher: consumer staples. Walmart is the bright red pain point, with weakness spilling into other staples names. That's why this session felt defensive and uneven, even with a green close. So what explains that heat map? Money flow was selective, information technology led, but only in specific spots: Apple and those key semis, while parts of megacap tech and communication services stayed heavy. Financials and industrials showed steadier green tiles, which fits a rotation tape. Meanwhile, consumer staples and energy lagged, and with small caps failing to confirm, the message from the market was pretty clear. This was not broad accumulation. It was narrow, cautious reallocation. Put it all together, and you get the real context. The market tried to look composed, but it traded like it didn't trust its own optimism. The tension sat around rates. Yields didn't explode, but they didn't cooperate either, just high enough to keep pressure on duration-sensitive names. And megacap growth, the usual leadership engine, churned without momentum. Not collapsing, just heavy. Underneath that, the AI debate stayed unresolved. Leadership is still there, but investors are clearly sensitive to capex and payoff questions, so the hesitation matters more than the close. On the chatter front, the loudest pocket was staples, specifically Walmart. Traders were talking guidance risk around WMT ahead of its February 19th earnings, and that kind of pre-earnings worry can drag a whole defensive group down with it. Separately, the market kept circling the same speculative story: AI capex anxiety versus AI leadership. None of this is a confirmed macro turning point, but it did shape how traders positioned today: cautious, selective, and quick to fade strength. Last night's Chinese New Year's Eve Spring Festival Gala was more than just entertainment. Unitree's humanoid robots doing synchronized martial arts were visually impressive. Fast direction changes, balance control, rotational torque, clean execution, no obvious instability. From a robotics standpoint, that kind of dynamic motion needs high-frequency control loops, real-time sensor fusion, and precise joint torque control. Even if the routine was pre-programmed, the execution screams hardware maturity, well beyond simple lab prototypes. And Unitree was not alone. Multiple robotics companies showed up in different segments of the gala, and industry reports say close to 10 Chinese humanoid robot firms are preparing or exploring IPO plans. When companies getting ready for public markets appear on the biggest national broadcast of the year, that's not just branding, that's strategic visibility. The Spring Festival Gala delivers national legitimacy, massive exposure, and policy alignment optics, all valuable going into capital markets, which raises a bigger question. Is this just tech progress, or the start of a new capital cycle? Now compare that with the US landscape. In the United States, players like Tesla with Optimus, Figure AI, Agility Robotics, and Boston Dynamics are focused on AI integration and industrial deployment first, before going public. The US model leans on autonomy, software integration, and commercial proof. China's approach looks more manufacturing scale-driven, supply chain efficient, and faster to public markets. Two different strategies, one global race. For US investors, this matters. If China speeds up humanoid robot IPOs and pushes production scale, global valuation benchmarks in robotics can shift. That would flow back into how markets price AI-linked humanoid plays in the US. So while last night looked festive, it may have quietly marked something bigger: the robotics race moving from lab demos into capital markets, and markets tend to price those shifts. Apple was the stabilizer. The stock jumped just over 3%, and that move mattered because it gave outsized support to the indexes on a day when the broader tape felt hesitant. The story in the coverage? Rotation into Apple as a perceived big tech safe haven tied to the market's nerves around AI capex and returns. In a session like this, when the generals are doing the lifting, Apple's bid doesn't just move one name, it sets the tone for the whole close. Nvidia stayed firmly in the leadership lane. The stock gained a little over 1% as the session chopped around, and it remained a swing weight for the market's direction. The key nuance: this wasn't a broad AI surge, it was targeted strength. Nvidia helped steady the Nasdaq even as other megacap names struggled to extend. That's why traders keep treating Nvidia as the tape's pulse. Broadcom was another clear winner inside semis. The stock climbed a bit over 2%, reinforcing that the market was willing to pay up for specific AI infrastructure leaders. And that matters because dispersion was real. Some chip names lagged even as Broadcom and Nvidia held up. Today didn't trade like a simple buy the whole sector day. It traded like, own the winners you trust. The most uncomfortable move on the board was Walmart. The stock fell almost 4%, and it didn't just hit one ticker, it set the tone for the entire consumer staples group. The cited driver was guidance risk chatter ahead of February 19th earnings. But the bigger takeaway is simple. When staples are bright red while the index is green, the tape feels like there's no easy shelter, just rotation and fragility under the surface. Microsoft landed on the heavy side of megacap growth. The stock slipped just over 1%, and the narrative tied it to investor sensitivity around AI spending and returns. This isn't about a collapse, it's about fractured leadership. When one megacap is acting as a safe haven bid and another is weighing on the group, the Nasdaq can grind higher, but it doesn't feel like a clean trend day. Energy wasn't the place to hide either. Exxon slipped more than 1.5% as the sector leaned red. In a session like this that matters, because energy often acts as ballast when other parts of the market are choppy. With staples also under pressure, energy weakness helped create that rotation without refuge feel, where the market leans even harder on a handful of leaders to keep the indexes afloat. Looking to Wednesday, February 18th, the calendar doesn't flag major U.S. data, so the near-term drivers stay the same. Earnings headlines, rate-sensitive positioning, and whether leadership broadens out. Practically, keep your eyes on follow-through in the generals, Apple and the semiconductor leaders, and on whether Walmart and the staples complex can stabilize. This market isn't rejecting the bullish story, it's stress-testing it. So that was the day, barely green on the surface, hesitant underneath. Narrow leadership did the lifting, small caps didn't confirm, and defensives didn't give the comfort you'd expect. The close doesn't really tell the story. The hesitation does. Next session, watch a simple tell. Do buyers chase strength, or do rallies get faded again? Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.